the move that we've seen in the market since March 9th is really, in many respects, a correction from the downdraft that we suffered earlier in the year in the anticipation of a complete financial market meltdown.
Yep, we thought things were rosy and hunky-dory, and then things came tumbling down. And of course, you saw what happened earlier when things didn't show any sign of getting better. In fact, all this stimulus just holding us steady, it seems, and maybe not really leading us to recovery. Chances are, folks, that you're sitting on some significant paper losses on whatever portfolio you have, your 401k or whatever you call it where you are. You got two choices, okay, essentially boiled down. I mean, I know you have more, but for urgency and simplicity, you can sit there and you can mope about it till the cows come home and hope they come back sometime down the line. You can get off your duff and do something about it. What the hell can I do when I'm so far down and out, you say? Paul Clitheroe is a longtime money commentator, founding director of financial planning firm IPAC, and the chairman of the Australian Government Financial Literacy Board. And a lot of us need more literacy out there. Joins us from Singapore today. Paul, good today, sir. Welcome to the show. Are people letting fear get the better of them?
Oh, look, humans are predictable. During a boom, we all become boom lemmings, and we believe the boom's going to go forever. I mean, the great story in my home country, Australia, was Chinese demand for resources. The Australian economy is perfectly located. The boom will carry on year after year. And I'm forever saying, for heaven's sake, look, the one thing I know is the truth. Booms don't continue forever. But the funny thing is, the second we get into a downturn, we get into the reverse psychology and we become bust lemmings. So basically, 2 years ago, everyone wanted to buy shares I spoke to. Today, people want to sell shares. Why do we not? Well, basically, we just always manage to get it wrong.
So basically, we're still like lemmings jumping off a cliff. We're just following the people in front. We're jumping on the proverbial bandwagon. We are not creative. We are creatures of habit, and birds of a feather flock together.
Well, in Australia, for example, 2 years ago, the average Australian was spending 102% of what they earn. In other words, we're chiefly credit cards and just saving. The latest information shows that we're actually now spending about 94% of what we're earning. In other words, we've gone from during a boom when you think we'd be putting surplus income aside. We actually find with humans, of course, during a boom, we're so confident we borrow and borrow, bigger car, bigger house, bigger boat, whatever it may be, run the credit card on holiday. But I find it quite fascinating, and this is why I do call this the cleansing part of the cycle. Because funnily enough, humans today, right across the globe, are actually behaving more logically with money in a bust. In other words, people are starting to look at their budget, put aside cash flow, because the issue we seem to forget is that, look, I can't control government policy. I can't control what these great big markets do. The only thing I can control is my personal financial situation. Now, you mentioned 401k. We've got an equivalent sort of thing in Australia. Most parts of the world do. And it just seems to me, if I'm now saving money because the downturn's frightened me, I'm worried about my job and so on, if I'm saving money, basically by topping up my 401k or equivalent, in my opinion, I'm buying assets when they're relatively cheap. Now, am I going to double my money in the next year? Wouldn't have the first clue. No one has got any idea what markets are going to do over 6 months, 1 year, 2 years. But as a 53-year-old, other 53-year-olds watching at the moment, for me to be putting effectively tax-deductible money into a 401k plan, 10, 15-year view, fantastic. I'm buying stuff while it's down.
I've got the perfect guinea pig right next to you, our good friend Brooke McConnell. He just happens to be 53 this year, if I'm not wrong. Brooke, are you taking Paul's advice? You know a thing about money. You're not cowering, are you? You're spending like there's no tomorrow.
Right, exactly. No, it's interesting you should mention that, Paul. That was the way people act in good times and bad. That's kind of what PIMCO's Bill Gross is talking about last night, in that this, like the Great Depression, has changed people's behavior. And they're now, going to be they're going to be more concerned about their future than they were 2 years ago. So it's very interesting that it follows up on what exactly you're talk about with the Australian.
Well, it's one of the reasons
Go for it, Paul.
Oh, I was going to say, it's one of the reasons that the Australian government, I chair the Financial Literacy Board, which is, we have a national strategy around financial literacy, and I've been most interested to be at quite a few OECD meetings lately, and including Asia, America, Europe and so on. There really is a substantial opportunity in this downturn to talk to people about money. Because in a boom, one of the things I hate about a boom is that risk gets completely disguised. In a sense, the more stupidly you invest, the better you look. And as the wonderful Warren Buffett says, it's only when the tide goes out we see who's been swimming naked. Funnily enough, we're seeing far more rational money behaviour. We're getting better financial literacy outcomes in a downturn. And I guess the role, certainly as chairman of the Financial Literacy Board for Australia, is that we're looking in Australia to make sure our education programs are ramped up, because we will go into a recovery. We will at some point in time be in the next boom. And my great, I think, hatred of booms is that we see some really silly human behaviour in booms about, risk and return goes out the window, we're all going to get rich quick. Reality, no, we're not. Risk and return remains a law of money gravity.
But, Paul, and during tough times when people are recoiling from, taking on risks and becoming very averse to it, seems like you're throwing out some pretty, risky, kind of ideas out there. You've been telling people in your columns to buy property. You want to take a look at stocks that are half the price of what they were, even if they don't bounce back to where they are. You can DCA, or dollar cost average out your per unit cost, and either way the math works in your favor. And you've been advocating getting in if you've got the job, you've got the income, if you've got the cash on the side.
Yeah, look, the issue for me is I always look like a bit of a dud. For example, my Channel 9 Australian TV show called Money, it tends to roll out every downturn. Why won't you see much of me during the booms? Because there's nothing wrong with the assets you're describing. The issue is leverage, okay? And the point I'm making here is that, in a sense, is that what I encourage people to do is I encourage people to have a budget, use their surplus income to buy quality assets on a regular basis, boom or bust. Now, the trouble is, because I'm not a big fan of vast amounts of gearing for everyday people around the world, during a boom, my stuff looks really dull. Because basically, buy decent assets during a boom without much debt, you get market returns. The big issue for me, of course, is you don't get smashed when the market's going down. So not for 1 second am I advocating, because prices are relatively historically low, I am not saying race out and borrow tons of money. What I'm saying is, if you've got surplus income, it's not a bad idea, particularly if you can do it tax effectively, to be using your surplus income to build up quality assets at a point in history. I'm not saying it's as cheap as it's going to get. I think the outlook's pretty gloomy. I agree with you guys. I think it's going to be a pretty tough couple of years, particularly around employment. But what I am saying is, if you've got surplus income, directing surplus income towards quality assets on a consistent basis, look, it's get rich slow, okay?
Okay. It all goes back to the regular, steady investment kind of theme. $25 every month is better than $250 in one go, because you can never time the markets. Paul, appreciate your thoughts. Paul Clitheroe from IPAC.